We're talking this week, Corey, about a February 2023 article in Kiplinger Personal Finance that talks about making your money last for a very long retirement. So the last 2 weeks we've talked about longevity risk, we've talked about saving in the right way, and today we want to talk about the third important point in the article, which is planning for healthcare costs in retirement. Fidelity Investments points out that the average 65-year-old couple will spend $315,000 in retirement on healthcare costs, and of course that could go much, and that could go much higher for people who actually live longer and end up needing long-term care.
Amber, half of people in nursing homes are age 85 or older. Well, in our first video, we put this chart on the screen, which shows that life expectancy for a 65-year-old male is 87 years old. For a female, it's 89. But for married couples, there's a 50% chance that one of them will live to age 93. So there's a 50% chance that a couple is going to spend far more than $315,000 on healthcare because one of them will need long-term care costs.
Now that's a very big number. So before you panic, we are going to talk about some ways today that you can plan for that.
Amber, the default answer for planning for long-term care for many years was buying a long-term care policy. Unfortunately, those premiums have gone sky high. So many people can no longer even afford them. And then what happens if you never use the policy you paid for maybe decades and don't get to use it? So the standard answer now for people wanting to plan for long-term care is what's called asset-based long-term care. And what this does is it leverages your current assets. Maybe it's a 401k, maybe it's home equity, maybe it's just a brokerage account. Anywhere where you have some pile of money, okay, can be leveraged for long-term care. Now, there are several ways that these type of plans can be structured, but essentially it's a long-term care insurance policy that has a set premium that you pay for a set number of years and then you're done. So in this example I'm going to put on the screen, we're going to show Mr. and Mrs. Sample, both age 60, one male, one female. Let's say that they plan on retiring around 65. So a few years before retirement, they project out how much won't they spend of their retirement assets and should instead divert for long-term care. In this example, we're going to say $100,000. So they have $100,000 from a retirement account that they're going to take out $10,000 a year at a time. So $10,000 a year, they're going to pay in for 10 years. So $10,000 a year, 10 years, Amber, the total they're going to pay in is how much?
$100,000.
$100,000 over 10 years. That will provide them with $318,000 tax-free to pay for long-term care, and that does include home health care. So what they've done is they've leveraged this $100,000 into $318,000 for long-term care. Should either one need it, now they have a bucket of $318,000 to put towards long-term care instead of the $100,000 they would have had.
Now the great thing about this is that if they actually don't end up needing long-term care, there's still money available to pass to their beneficiaries.
Yeah, Amber, that amount would be about $160,000 would be the death benefit if they don't need the long-term care. So again, it's not a use it or lose it type scenario. But in our last video, we talked about saving the right way and should you be considering a Roth conversion to lower your tax bill. This is one way you could do that, Amber. If you have excess money in a retirement account, you could pull out $10,000 a year, pay the tax, and then reposition it to a tax-free long-term care policy to cover you and your spouse should either one need long-term care.
Now maybe you don't have that kind of money to divert to a plan like this, but one thing the article points out is to not discount probably what is your largest asset, which is your home.
That's right, Amber. Most people, when they retire or soon in retirement, no longer have a mortgage. Maybe they have a $300,000, $400,000, $500,000 home with no mortgage. That equity is available. Okay, that could be pulled out to pay for long-term care. That could be pulled out to supplement retirement income if needed or if inflation takes off. So don't discount that. Maybe that's not your go-to plan. Maybe you don't go take a home equity line of credit right when you retire and you just keep it in your back pocket. You just say, hey, if I need long-term care, we can always tap the home equity. That is a very viable option and one we have seen used a few times in our office.
So as you are planning for what might be a very long retirement, make sure that you're taking into account healthcare costs and perhaps even long-term care costs.
Yeah, it's gonna be expensive, so plan for that. But again, a proper retirement plan will include some of this and have some budgeting. So don't miss our last episode coming out next week, where we're gonna discuss how to position your portfolio, how to invest to cover longevity, taxes, and long-term care. That's the grand finale next week, where we try to help you make the rest of your life the best of your life.
Plan now to retire happy.